Come hither, my nerds, come hither, because today we are talking about the financial Super Bowl for us nerds that are paying attention to the largest publicly traded companies in Canada. Of course, we're talking about the banks, and God knows the wife doesn't want to hear it, the family doesn't want to hear it. I'm very thankful I've niched out a small part of the internet where you nerds want to sit down and listen to this with me, because it gets me excited as hell with major exposure that I have. And I know if you love your dividends, you're getting the same exposure through VDI, my monthly paying Canadian dividend ETF until I die, that ticker VDY, because you know it well. 25% of every damn dollar I put into this ETF, or 25 cents, is going to Royal Bank and Toronto Dominion. Though we don't have those earnings yet, we do have that pregame going on, a little bit of prelude here with Bank of Nova Scotia. Hint, they were tech-like returns out of what is supposed to be a financial destruction of our economy, because mortgages were supposed to default, the tariff war was supposed to put us into an economic recession, and guess what? None of that happened. So they all lied. The media just clickbaited the hell out of you and ruined your long-term rates of return, because through all of it, I was buying very aggressively. And now we're doing exceptionally well. As you know, VDY, I mean, it's up 25% with the dividend this year, and I was very much relying on the banks to post great earnings to see that propel even further into the future, because even today, you're still being lied about. And we'll talk about it in a moment, because everyone's saying don't buy the banks. Now they're too expensive. Before it was an economic collapse around the corner, and now they're just too damn expensive. Ha ha ha. Clickbait money media. Ah, God, it's such a joke, but it does give you that window of opportunity as it fearmongers everybody into doing dumb decisions with their portfolios. Regardless, as you guys know, Royal Bank is going to be posting tomorrow on the 3rd. Today's Tuesday. Tomorrow's Wednesday. TD is going to be on the 4th. We got BMO on the 4th. Bank of Nova Scotia today. The only bank to post today, and is also one of the smaller banks, but Canadian Imperial's posting on the 4th. National Bank on the 3rd, but nobody really cares about National Bank, even though it's been one of the best performing banks here in Canada, a bit of a smaller one that's been an up-and-coming star. Regardless, guys, here's the hint. Bank of Nova Scotia is up 2% on absolutely astonishing numbers. I'm not joking. It's actually been quite ridiculous. It's paying a 4.5% yield right now and trading at an 18 times multiple, which seems quite ridiculous for financial institutions until you see the numbers. And if this continues for another year, you can quickly justify a 18 price to earnings multiple, as Bank of Nova Scotia now trading at an all-time high. Need I remind you, just an odd year ago, you could have been picking this stock up, not even a year ago, guys, like literally just a couple quarters ago, you could have been picking this sucker up for a 6.5%, 7% yield, which I'll remind you is the highest yield Bank of Nova Scotia has ever paid in its entire history. That was the disconnect in value in the market because of the concerns of the clickbait media trying to drive the banks into the ground, claiming mortgage crisis, economic uncertainty, tariff war, this, that, and the other, immigration slowdown, you name it. Regardless, the banks are resilient as hell. We've been through 2008 financial crisis, mortgage crises in the 90s, you name it. The banks in Canada, world recognized because of their stability and their resilience, their low payout ratios, the reliable dividend growth. The government's mandate control over these banks because they're monopolies in this country, and that has proven to bode excessively well for shareholders. So regardless, we're back to a more normal dividend yield. Might I add, you could say this is too low of a place to buy, but this is historically the yield Bank of Nova Scotia has been paying out if you were buying it. So let's look at the numbers themselves. This is where we really get to nerd out, guys. But we'll look at total revenue first of all. Total revenue is up 15%, $9.8 billion from $8.5 billion this time last year. How are they doing this? I have no idea. It is nothing short of exceptional, but we'll get an idea as we dive a little deeper. Net income, $2.2 billion versus 1.6, almost 1.7, guys. Can I just tell you, like, if you take a look at that, guys, that's a diluted EPS was up 35%, adjusted was up 23%, and again, revenue up 15%. Those are the kind of numbers we've seen out of Google, might I add. You know how disgusting that growth level is? Like, it's insane. It's insane. Now, keep in mind, provisions for credit losses continue to trickle up a little bit, but as we look deeper into this, you'll see provisions have kind of leveled off. We're not growing anymore to any excessive rate, and we'll dive a little bit deeper into that in a moment. But look at the total assets. This company's managing $1.46 trillion now versus $1.412 trillion just this time last year. So they're also seeing quite, especially like recently, they saw quite a huge bump in total assets, which again, quite incredible. Now, I want to point out to you guys that we scroll all the way down here, what you're going to see is the book value per share, which was $62 now and 22 cents. So if they liquidated all of their assets, paid off all the debts, refunded everybody, whatever money they've got, they would be worth for us as shareholders $62 and 22 cents. If they ever trade below this, you want to buy the living hell out of it. Regardless, they were actually trading right in line with this just during the April tariff war. They were trading at $64 a share. That is the window of opportunity you get. There are very rare opportunities where the market freaks the hell out and oversells these off. And though, again, you could say it's expensive trading at $97, these companies will trade at premiums with the growth rates that they're currently offering, right? So you can't say they're expensive when they're growing their earnings at a 30% damn clip, guys. Like, what the hell? Like, you know how crazy that is? And if you're a dividend investor, you're not really going to be complaining at $1.10 was the payout, which was up from $1.06 this time last year. But again, guys, when you look at the actual earnings per share, the net income here, like their payout ratio is not much. I mean, when their diluted earnings is $1.93 and their dividends like around $1, like their payout ratio is probably around what, 60% right now. Like it's excessively low in like the 50-60 percentile range. Typically the banks, their payout ratio is around 50% as it is. Regardless, guys, regardless, this is beautiful. I mean, again, this is one of the few banks. I think there's only 2 banks right now that are seeing an increase in loan loss provisions, but we'll talk about it in a moment. First, let's break down the sector performance to get an idea of where the growth is coming from, because again, the Canadian banking sector is not the most resilient for them. I'm surprised Royal Bank has grown as well as it has, but I think Royal Bank kind of cheated a little bit by doing that acquisition of HSBC. And that, I know I say that a lot, but that has been a driving factor for a lot of their growth, because you can see just pure play banking, there's not a lot of growth going on because net income was only up 1% and revenues were up 3%. So nothing like astonishing by any metric here. But if we take a look at like Global Wealth Management, up 18%, net income, revenue was up 16%. So Global Wealth Management crushing, like absolutely crushing. And then Global Banking as a whole, net income up 50% and revenue up 24%. So Bank of Nova Scotia is doing much better outside of Canada. And I guess that's kind of the diversity you get with this bank, which helps a little bit. Toronto Dominion gives you a little bit more US exposure. And then obviously Royal Bank is probably one of the purest plays to the Canadian banking sector, right? International was only up 3% with the banking side of that. But yeah, global banking and markets, I don't know what's going on here, but my God, that's like their highlights of the insane growth period. But when it comes to the provisions for credit losses, and if we take a look, so Q4 of 2025, we're sitting at about $1.1 billion, right? The peak was in Q2 of 2025 at around 1.4 billion. And if we take a look, like even Canadian banking here, again, these are impaired and performing loans, right? Canadian banking basically is at 494, which peaked at 805 in Q2 of 2025, and international banking is at 595, which is still slightly below the peak of Q1 of 2025 at 602 million. So just keep that in mind, that things again aren't materially increasing. They've leveled off and started to deteriorate a bit, which is giving people a sense of ease and confidence in the potential future of these banks returning to new higher levels of net income. Because as soon as they slow down on those provisions for credit losses like we saw for Royal Bank, we could see some massive explosion. And even regardless, that really hasn't taken effect for Scotiabank. Again, even with the loan loss provisions that don't get included in the net income, their net income was still up. Like, God, double digits, guys, double damn digits. Like, come on, are you kidding me, right? And you can just take a look here at the average loans by business. On the Canadian side, it is mostly mortgages that make up the vast majority of the Canadian banking side. When it comes to the international banking side, it is a lot of business loans, a bit of mortgages, some personal in there. And then when it comes to global banking and markets, where they're seeing, I guess, what some of the highest rates of return is almost all business loans. So that's kind of the snapshot for this bank that's done an exceptional job at growing its dividends. It's not the biggest dividend grower. Keep that in mind. Over the last 5 years, the scorecard's been around 3.7% over the last 5 years. But something tells me, and I've said this before, guys, I would expect in time, we're going to see bigger than average dividend increases if net income continues to scale at the way it's scaling. So let that just sink in, that yeah, you could say they're expensive, but they're growing excessively. The opportunity to really load up on these has now come and passed. Am I that excited to continue to load up on VDY? Not like I was, but I still have to accept that we are in a new growth period for the Canadian economy, unlike any time we've seen in the past. So I'm just thankful that I was able to get into this early enough to lock in a crazy return for this year, and we'll continue to cost average moving forward. But again, I'm just thankful that I've been here for this, and that we captured some of this, and that we've been playing it as intelligently as we can, trying to, sift through the noise in the markets and just stay steady on our journey to financial independence. And if this channel helps you do that, all I ask in return is hit that subscribe. You want to talk to me one-on-one, support the channel, go to KyleLivingston.com. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.